Every credit card statement in the United States is legally required to show you a box with two numbers. Almost nobody reads it. And the numbers inside are designed to make you uncomfortable on purpose. It's called the minimum payment warning. Federal law has required it since 2010, after the Card Act passed. And it tells you two things: how long it will take to pay off your balance if you only ever pay the minimum, and how much total interest you'll pay by doing that. For most balances carried at a typical credit card interest rate, paying only the minimum stretches payoff into the double digits, sometimes 15, 20, even 30 plus years, depending on the balance and the rate. And most people never see that number, because the box is small, and the required minimum payment feels manageable. Here's the part that surprises people most: on many cards, you can end up paying more in interest than the original amount you borrowed. Not close to it. More than it. The purchase you financed becomes the cheap part. The interest becomes the expensive part. The mechanism behind this is simple, but it works against you quietly. Minimum payments are usually calculated as a small percentage of your current balance, often somewhere around 1 to 3%, or a flat minimum dollar amount, whichever is higher. As your balance slowly drops, your required minimum drops too. Which means the payment keeps shrinking relative to what you still owe. It's not designed to pay off debt quickly. It's designed to keep the account open and generating interest for as long as possible. Credit card interest also compounds daily on most cards, not monthly. Every day you carry a balance, interest gets added to that balance, and the next day's interest is calculated on the new, slightly larger number. Over months and years, that daily compounding is why the math gets so much worse than people expect from a rate that sounds moderate on paper. This is exactly why the second number in that federal warning box matters so much. It shows you what happens if you pay a fixed amount that would clear the balance in 36 months instead. In almost every case, that fixed payment is only somewhat higher than the minimum, but it can cut years off the payoff time and cut the total interest paid dramatically. You don't need a course in finance to use this. It's already printed on your statement, in a box you've probably scrolled past 100 times. The next time your statement arrives, that box is the first thing worth reading, before the balance, before the due date. If you're carrying a balance right now, the move is straightforward: pay more than the minimum whenever you can, even a small amount extra, because in the early months of a balance, almost your entire minimum payment can be going toward interest rather than principal. Extra payments go straight at the part that's actually shrinking your debt. 3 things to remember. The minimum payment is calculated to protect the card issuer's interest income, not to get you out of debt quickly. Daily compounding means every day you carry a balance adds to what you owe. And the payoff time box on your statement, required by federal law, already does the math for you. Use it. Debt doesn't usually trap people through one bad decision. It's the slow math of a small payment, repeated for years, that nobody bothered to check. Now you have the number. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every week. I'll see you in the next one.